Hello and welcome back to Bonex Investment Group. In this video, we are going to go through a very important lecture which those who are going to take seriously will see results. So we understand that the market goes up and down. Anyone can see the markets actually moves in an upward or downward bias, and this creates what we call waves that we see on the markets. If you have been in the markets, you know that the market creates waves like this. So basically, wise traders are able to execute within these waves, meaning that buying the rallies and selling the dips is actually the sole purpose of traders. That's the main job for traders. We try to buy the rallies or sell the dips. For if actually there is a mistake, it's actually vice versa. And before we talk much about this concept, let's highlight the fundamental concepts that are required to know for you to actually execute using the stress-free strategy. So firstly, we need to highlight what moves the market. So the main driver of the markets are the fundamentals. I've seen quite a lot of traders who do not want to know what is taking place within the news side of trading, but that is the main mover of the markets. So basically, I use Forex Factory as well as I use FX Street to find the fundamentals of the markets. So when a particular economy strengthens, we will see a bullish move of its currency. Then the other thing that also moves the market is the sentiment. Sentiment also plays a role. However, many traders observe technical. So basically, technical is one word, one style, and sentiment I use advanced analytics that is offered by my broker HFM, and that also tells me how traders are distributed within the markets. So when all three are combined, we will create waves that we see on the charts. So basically, the supply and demands, the news, then the reactions to the technical side is what gives rise to the waves that we see on the charts. So these waves offer points of entry, and this is where our stress-free strategy gets in use. Where do we enter, right? If we know how to use this, we will definitely have a simple entry style. So basically, let's start by defining the waves. What are these? How do we use them? So to remove the market subjectivity, by subjectivity we mean the effect whereby one trader sees this type of thing or sees that type of thing, we need to define a wave using the Fibonacci retracement tool. It's actually a very basic trading tool. The Fib retracement level 2 is found by default on the market, the MT4 or MT5. So by definition, a wave is an impulse with a retracement of at least 38% or 38 to 70%. We are saying when we see a drop or when we see a rise, we only validate this as an impulse, as a wave, if we see a 38% retracement of this particular move, or a move, a retracement that will reach at least at most to 70%. So we would say this is actually a wave like that. So this is basically the rule that you need to take into consideration when validating these waves. So while counting or observing our technicals, we must see 5 valid waves as shown. Let's have an illustration. We are saying whenever we see 5 valid waves, we will actually get a reversal of the markets, and that is where we would want to make an entry. So if we say the first wave, second wave, third wave, fourth wave, and then the fifth wave, which will be at this particular point, validating these, requiring this retracement of at least 38% retracement of this first move, 38 to 70% of this second move, will actually get a point of retracement. So this all boils down to the time frame of observation that you're looking at. If you're looking at 1 hour or H4 time frame, we are actually talking of swinging, and if we're looking on M15 down to the M1, we are actually looking at scalping and day trading. So it all boils down on how and what you prefer most to trade. Are you a swing trader or are you a day trader? So let's now go over the charts so that we can simplify the explanation with visuals. But before we do so, please check out our free Telegram channel. I'll leave the link in the description box below so that we will be together in one community. Alright, so we are going to use gold, and as always, this strategy works on each and every pair or asset class. On gold, we can actually see that this was in January, and we are just going to start off from this horizontal part where there were not clear moves or where there was consolidation, as we always say. So the first thing is actually to look for a wave that is coming out of consolidation, and in this particular case, what do we see? We see that there was actually a move from this consolidation to this particular point. So I have just taken the Fibonacci retracement to pinned the lowest and the highest so that I want to check if this gap was actually a valid wave. We can see that this gap made a retracement that actually reached above 38. It was actually below 38 and within the bound of 70%. Therefore, this was actually the first move, the first wave to the upside. Then we wanted a break of structure which occurred at this particular point, and to validate this wave we need to check whether there was also a retracement of 38 to 70%. We can see that it was actually at 50%, meaning that we now had first valid move, second valid move to the upside, and we now have wave 1, 2, 3, 4, and now at 5, that is where we actually look to get an entry. At 5, we actually wait for break of structure, and after break of structure, we need a candlestick reversal pattern, a valid one, which we talk about. If you are not aware of the candlestick reversal patterns, you can check one of our videos on this channel. And in this particular case, we had what we call a railroad track that was issued, and that was actually an entry point. So an entry point, our take profit is actually at wave number 1, 2, 3, 4. At wave 4 level, that is where we put our take profit, meaning that our take profit was going to be hit. This is on the M15 time frame, and on that M15 time frame we can see that the take profit is actually quick to hit because it's actually a small time frame. It's a day trading time frame. So if we try to look for waves on the higher time frame or on the larger scale, we would say this was actually one wave to the upside, and we can as well check for its validity to see if it had the proper retracement. The retracement was actually within the bound, and then this was going to hold as wave 1. Then the second wave was actually going to be this, which was also within the bound. Therefore, after break of structure of this particular high price, that is where we start to look for an entry. We can look for a pattern like a double top, double bottom, head and shoulders pattern, and so forth. So in this particular case, we can see there were several candlestick reversal patterns, and on the H1 time frame, that is where we have most powerful patterns. So it would be better to switch on the higher time frame to see a proper closure of candlesticks so that you can make an entry. So just to make a recap of what we've said, we need to see waves that have the proper retracement, and from that we need to see 5 waves, and at the 5th wave, that is where we start to look for an entry. And the 5th wave should always has to be above, or has to be a point that is reached after breaking the structure of the previous wave. On that note, we've come to the end of this video. Thank you for watching. Like and subscribe, and I'll see you on the free Telegram channel.